What's up, you guys? This is probably one of the most important videos I've made so far when it comes to finance, and that is what goes into your credit score and how to build your credit score. This is definitely a finance fundamental, as your credit score is an important part of your overall financial health. So if a friend asks you to borrow $100 from you, would you do it? Be honest. You're probably like, hell no, I'm not doing it. No, but for real, guys, you probably would think to yourself or ask yourself, well, it really just depends on the friend. Are they trustworthy? Have they borrowed money from you before? And if they did borrow money from you before, did they pay it back? And if they did pay it back, did they pay it back on time, when they said they would? These are probably all the things that you would ask yourself. Well, borrowed money is old as civilization itself, and for a long time, borrowed money was based on personal relationships. Personal relationships, or if someone the lender trusted would vouch for the borrower. In 1956, a data analytics firm called the Fair Isaac Company started creating mathematical models that used a borrower's history to measure their risk. And in 1989, debuted the first industry standard algorithm known as the FICO score. This is a formula that was adopted by three major credit bureaus: Experian, TransUnion, and Equifax. Your FICO score is a 3-digit number between 300 and 850 that is meant to be a numerical representation of how safe it is to lend money to you. It is a measure of risk that lenders use. The lower your score, the more risky of a borrower you are perceived to be. The higher your score, the more you're perceived to be less risky. A high score says to the lenders that you will pay the money back on time, and a lender will be likely to give you very good terms. On the other hand, a lower score says you might not be able to pay the money back, so if they do decide to offer you credit, they're probably going to want to protect themselves and be compensated for this risk by charging you higher interest rates. Now, with that being said, it's important to remember this number does not represent who you are as a person. It does not represent who you are as a person. For example, there are people with high credit scores who live paycheck to paycheck. There's also people with lower credit scores who are excellent savers and great providers. For myself, I understand that life happens, and there could be so many reasons why you have a low score. It could be a time in your life where you were laid off for an extended period of time with no income. It's possible that maybe you got hit with medical bills, unexpected family emergency. I mean, life happens. There's so many things that can happen in life that can result in a low credit score. Now, Rafiki from Lion King would like to offer some words of wisdom.
It doesn't matter. It's in the past.
Yeah, but it still hurts.
Oh, yes, the past can hurt. But the way I see it, you can either run from it or...
Thank you, Rashiki. That being said, in this video, I'm going to go into depth of what goes into your credit score and what you can do today. What steps you can take to improve your credit score as quickly as possible. So make sure you stay tuned to the end of the video to get this valuable information. If you like what you've heard so far, please hit the like button and let the YouTube guys know how you're feeling right now. So your credit score reflects your past relationship with debt. And with any relationship, you can always make changes and make it better. You don't have to be stuck in a bad relationship, much like you don't have to be stuck with a bad credit score. So every time you open a new credit card, you make a payment on a credit account, you make a student loan payment, all of this activity goes to the credit bureaus where it goes into and is processed by the FICO algorithm. However, not all data is judged equally or the same. So the largest part of your FICO score is based on your payment history. Your payment history accounts for 35% of your overall score. Now, with that being said, missing a payment is one of the worst things you can do. So an immediate way to improve your credit score is to make sure that you pay all of your credit cards and loans on time. The FICO scoring system also takes into account how long and how many times you missed a payment. For example, someone who's not made a payment in 90 days will be hurt more than someone who has missed a payment in 30 days. Late payments are like falling and breaking your hand. It will eventually heal, as long as you don't break your hand over and over again. Now, the second largest part of your FICO score is based on your credit to debt ratio. So let me give you an example. If you had a $1,000 credit limit on your credit card and you have a balance of $750, that means that you're using 75% of your available credit. When you have credit to debt ratios like the example I just gave, it's like driving a car on a low tank or an empty tank of gas, and it's seen as more risky to the credit bureaus. So another way to improve your score is to pay off or pay down these balances as quickly as possible to get an immediate boost. If you are able to maintain a credit utilization at or under 30%, this would be the best way to improve your credit score. So in that example, if you have a $1,000 credit limit, you want to ideally use no more than $300 of that availability, which would give you a 30% utilization. Let's give another example. Let's say that you're not able to pay down the $750 right now on the card with the $1,000 limit. If you had another card with a $1,000 limit, you'd be better off spreading it out. So you would have $375 on 2 different cards versus having one card with a balance of $750. Another option, when possible, is to increase your credit limits over time. Now, with that being said, it does not mean to go out and rack up more debt. Credit and credit cards are just a tool, and when used properly, they can be very valuable. Let's say that you still have that $750 balance, but your credit limit was $2,500. Now that would represent a 30% ratio versus a 75% ratio with a $1,000 limit. The length of your credit history makes up 15% of your credit score and is based on the ages of your various accounts. This is why older people tend to have higher credit scores than younger people, with all other factors being equal. So when you are young and starting on your credit journey to build credit, the most important thing you can do is to make sure that you make your payments on time and keep your credit balances under 30% when possible. Now, as you get older and now you have 10, 20, 30 years plus of credit history and you're paying your bills on time, your credit will get an automatic boost as you have a longer credit history limit. This is why I feel that getting a credit card early but using it conservatively and responsibly can help you have a higher credit score later in life. Now, 10% of your credit score is based on credit diversity. So there are 3 main types of credit. The first one is revolving credit, also known as credit cards. The second type is installment. That is student loans or car loan are the most common examples of installment. And finally, you have mortgages. An ideal credit has a mix of all 3 credit types because the bureaus want to see how you manage all different types of debt. The last 10% of your credit score comes from new lines of credit and credit pulls. So if you apply to a bunch of new credit cards, loans in a short period of time, or if many different lenders have to check your credit score, that could be a red flag. However, with anything, there are exceptions. So if you're shopping for a car loan or a mortgage, you'll usually have a window of about 1 to 2 months where multiple pulls on your report will not affect your score as much. This only applies to pulls done by potential creditors called hard pulls. When your credit is checked by a creditor, that results in a hard pull, also known as a hard inquiry. Now, when you do a self-check on your own credit through, like, let's say Credit Karma or a credit monitoring app, this does not impact your score and is known as a soft pull, also known as a soft inquiry. This is also the same when employers or landlords, etc., do a credit check. So the FICO model is the main way your credit score is calculated, but there are other variations of the scoring system depending on what the lender wants to know about you. It's also important to remember that a low score is not the end of the world. It's not the end of the world, guys. But there are life goals that a good credit score can make a lot easier to achieve, such as owning a house or starting a business. Now, if you want to have an idea of where your credit score is, many credit card and auto loan companies are now providing that information for free on your monthly statements. Another good site, and one that I use myself, is called NAV, N-A-V, and I've included the link in the description box if you're interested in signing up. With NAV, you can get access to all 3 credit scores on a monthly basis. They also provide a chart so that you can see how your score is trending from month to month. Now, honestly, it may seem a bit creepy or invasive that all of these companies or organizations are monitoring your activities to pass judgment, but it really is just a modern day version of borrowing. of a borrowing reputation. I really hope after watching this video you have a better understanding of what goes into your credit score and what you can do to improve it. If you enjoyed this video, please hit the like button on the video and subscribe to the channel for more information, as I am posting on a weekly basis. I would also like to know, what are some of the changes you plan to make in order to improve your credit score? Please comment in the sections below. And as always, I, Joe, also want to know what you know. Thanks for watching and have a great day.